Welcome to today's webinar, co-hosted by Treasury Prime and Unit 21. I'm Sheetal Parikh, Associate General Counsel and VP of Compliance at Treasury Prime. And the title for today's webinar is A Shifting Paradigm, How Sponsor Banks and Fintechs Are Leveraging Innovation to Enhance Transaction Monitoring. This is a topic that we feel clearly highlights a growing tension we see in the financial services fintech ecosystem today, where we have banks and other traditional financial institutions wanting to invest in innovation and unlock new product lines by banking fintechs. But there's not necessarily regulatory support or a regulatory blueprint to effectuate the transformation. We've seen regulators, including the CFPB, OCC, FDIC, invest in offices of innovation, but there hasn't really been clear discourse or guidance to fintechs or banks on how to make adjustments to traditional disciplines like transaction monitoring, BSA, AML, and regulatory compliance in general to account for this shift that we're seeing in the risk profile that fintechs often present. It's a topic that we know is top of mind for banks and fintechs alike, so we're super excited to have this conversation today. Our panelists have been on the front line of not only understanding and addressing some of these concerns, but really helping create a solution for it and closing the gap that we see between regulatory compliance and innovation. So before we introduce today's panelists, just want to remind you all that the contents of today's webinar are informational only and shouldn't be construed as legal advice. So with that, we'll kick off and I'll turn it over to my panelists to introduce themselves and their respective organizations. And we'll start with
Tanya. Hello, I'm Tanya Corder, the compliance manager at Treasury Prime. I have over 7 years experience in the compliance space with direct investigations as well as program side of compliance and in both a fintech and banking compliance framework. Prior to Treasury Prime, I worked at Amazon for numerous years on lots of different compliance products, including Amazon Payments, cryptocurrency enhanced due diligence, and managed global sanctions screening program efforts. I'm certified anti-money laundering specialist and have my virtual currency and blockchain certification through ACAMS. And a little bit about Treasury Prime, for those who aren't familiar. We're a company that builds API banking technology to embed a full range of banking services, from cards to account opening to payments and such. Over to you, Matt.
Thanks so much, Tanya. Hi, everyone. My name is Matt Lifshotz, and I head partnerships at Unit 21. Just some background on myself. So I've spent the past 10 plus years in a variety of different business development and partnership functions across fintech, fraud, and risk industries. And so at Unit 21, as the head of partnerships, I lead our channel and technology strategy. And just previously, just for additional background, I led channel and issuer partnerships at Riskified, which is an e-commerce and fraud protection company. And then before that, I led business development and partnerships of a very early BaaS company called Choice Financial. This is well before banks were leveraging APIs. And so timing is everything. And it's great to see that my friends at Treasury Prime have got the timing right. At a little bit background on Unit 21. So Unit 21, we are the only no-code operating system for risk and compliance operations professionals. We empower leading banks, fintechs, lenders, and brokerages and crypto companies with automation and control and visibility in their battle against fraud and money laundering. Our goal is to remove the engineering barriers that are needed to build, test, and deploy rules, models, and workflows across 3 primary product lines: identity, transaction monitoring, and case management. We have partnered and integrated with Treasury Prime, so transaction data seamlessly pass from their ledger to the Unit 21 platform, allowing banks and fintechs to immediately protect themselves against financial crime. Thanks, and looking forward to the conversation.
Excellent. Well, thank you both so much for taking time to be a part of this conversation. Maybe a good place to start, Tanya, is before we get into the substance of transaction monitoring and different approaches, maybe just getting into some background on what is transaction monitoring, and specifically as it relates to this paradigm where we often have partner banks and fintechs and sometimes even BaaS providers. So maybe you can talk a little bit about roles and responsibilities and give some background there.
Yeah, I think we're all familiar with the Bank Secrecy Act and the current laws around it, where all registered financial institutions, such as banks, They have an obligation to report on any suspicious activity that relates to money laundering, terrorist financing, sanctions violations, and so on. So roles and responsibilities, as of today, they really live with the financial institution when it comes to transaction monitoring. However, what we're seeing is that roles are starting to shift. We see new entrants of banks decreasing and fintechs are booming all over the globe. And it's because of their cutting edge innovations like blockchain and artificial intelligence. All of these nuances are ushering in new ways of doing business in the financial industry. And I think regulators are seeing this and they recognize that as well. So, on a high level overview, there's really two sides to this question. From one side, it's clear that financial institutions are regulated by regulatory agencies, but on the other side, where it's a little unclear is where it's pertaining to fintech companies. Virtually everyone in financial technology, or at least the activities, are regulated. But as of today, laws regarding fintech specifically, they just haven't been ironed out in the US. So banks take on the majority of the fintech's burden when it comes to transaction monitoring. But this doesn't mean that fintechs can't suffer consequences. Consequences can still be quite severe, even if regulators don't think, or if regulators don't think that fintech is a good actor, like even if that fintech specifically isn't necessarily regulated.
Yeah, and I think that is a good segue to talk about this whole idea of a sliding scale and like a shifting risk profile, which really I think is kind of at the heart of what today's conversation is about. And Matt, maybe you could, in light of that background that Tanya just gave us, and this idea that even though banks today are still the regulated financial institution, things are shifting, and even though it's a little bit in the gray area today, how could a bank leverage technology to really account for some of this shift that we're seeing?
Yeah, it's a great point. I think when you think about banks, right, this is a interesting business model for them to start working on because they've typically operated right. They know their customers, they understand the products that they're offering, they know the customers that they're targeting. As you're starting to work with different types of fintechs, the fintechs are entering new lines of business. They're targeting new types of customers. They may be expanding into delivery of new products and services that you may be familiar with, but in new types of like wrappers, new delivery methods to different customers. And so when you're thinking about that, you know, banks need to adjust to how they're monitoring those types of transactions. So they need to be looking at things. They need to have flexibility in terms of how they are able to adjust to new types of fintechs when they're adjusting their offering. They need to be able to think about working with fintechs on the front line, treating them as a way as an extension of their own staff, so they know their customers really well. So how are they collaborating effectively with fintechs to be able to understand suspicious activity or what may not be suspicious activity? And lastly, I think clearly, how are they just able to adjust quickly? How are they able to, as fraud patterns are shifting across their fintechs, how are they able to quickly, and I mean not within weeks or months, I mean within days or hours, if necessary, adjust their models to be able to account for different fraud patterns?
So it sounds like the problem is it's almost like we are dealing with traditional products that are being consumed in a totally different way, and that is giving rise to these new risks and almost requiring new pieces of technology to address them. Could you, Matt, maybe give us some examples? I think we've talked generally about the shifting framework and risk profile, but maybe some examples of a use case that would warrant a different approach to transaction monitoring.
Yeah, I think one thing as you looked is what some of our clients maybe have encountered within the fintech space, right? One of the major benefits that fintechs bring is that customer experience. So the ability to quickly and seamlessly open accounts, right, online, and that's great, right? That's an unbelievable customer experience, but it does potentially have some drawbacks. So in one case, what we were finding We've seen cases where identities were stolen and then rapidly used to create a large number of accounts across a fintech. And I'm talking number up to 100 accounts under each identity. After that, we're having quickly that these accounts start usually handling micro deposits. So they're able to pull in a large amount of micro deposits. You're looking at like under $10 from fraudulently linked third-party accounts. And then these accounts that were receiving the micro deposits, they can continue to consolidate them into a single account. And then that single account transfers to another stolen identity within that fintech. And that process is repeated and repeated in funnel accounts. And then eventually the goal is for a fraud, someone that's acting as a fraudster, is to move those funds outside to an external bank account. And if you think about that, it's one case with one fintech.
Yeah.
And then if you think about managing multiple different types of fintechs, how are you appropriately putting in place the appropriate models and rules across your fintech portfolio to catch different types of fraud patterns?
Right. Because in our traditional approach to transaction monitoring, we're often looking at these at a transaction by transaction basis, right? And so we're not necessarily getting that holistic picture. But Matt, I want to pick up on, you mentioned customer experience, and I would love to kind of pick up there, because that is something, Tanya, that we hear from banks as much as fintechs. The customer experience piece is their value prop. And we've seen, especially during this global pandemic, that customer experience is really driving how consumers want to interact with their financial services organization. So it is really at the heart of what fintechs deliver. We often, talking about kind of this regulatory tension, we hear from a lot of our bank partners that there is this tension with balancing the customer experience with regulatory requirements. So, you sat in a BSA team at a regional bank before. How would you kind of counsel a financial institution or a bank on how do you go about kind of effectuating these programs as it relates to new approaches to transaction monitoring, looking at a fintech portfolio?
Yeah, I think it's crucial to have those internal conversations initially with your compliance team, with your leadership team. As Matt has mentioned, the activity looks very different. So it's important to really understand that the activity is going to look different, and evaluate whether your monitoring tool that you're using at a bank, if it's going to account for that activity. I think banks are quick to follow the letter of the law and really miss the spirit of the law. So when looking at tools, I think, banks, they think of, oh, this tool is familiar to us, this tool is familiar to regulators, so why not just use that tool? But what they really miss is that the tool doesn't have the capabilities of really capturing the activity that is going on with these fintechs and the customers at the fintechs. And what we really will help banks understand is that the very nature of fintech business is very different from regular banking activity. It requires a different approach to transaction monitoring, and specifically the type of risk that's at hand in the fintech context, where there often are different types of risks that a traditional tool isn't able to monitor.
Yeah, absolutely. And, I think it sounds like what we're seeing often is we're getting so enamored with the tools and kind of the formalistic view of adjudicating alerts, number of alerts. And partly that is because of how regulators are examining banks, that we're maybe kind of moving away to looking at the effectiveness of the tools. But let me ask you this, Tanya, what about the concern that, okay, so now if we have different ways of monitoring different types of transactions, whether it's fintech or kind of core business, transactions that are going through the bank's core, how would we get a regulator comfortable with having two different tools and having to explain that there's still one comprehensive AML program?
Well, I mean, what regulators really want to see is effective risk management. And with traditional tools that banks are using to monitor banking activity, there's always like a piece of that puzzle missing. We see money coming in at a bank with traditional activity. We see money coming in, money coming out, but what's going on in between remains a mystery. And sometimes, there's 314B collaborations where you can reach out to another institution and get a better idea, get a sense of what's going on to be able to effectively say, yes, this is suspicious or not. But having that collaboration and working directly with fintechs is similar, where they know their customers, as Matt has mentioned. They know their customers. They know what typical activity looks like for their line of business, for their individual customers, and it just makes so much more clear of a picture the type of activity that the bank is going to be investigating on. And roles and responsibilities, they stay with the bank. As I've mentioned, the bank is still responsible for filing SARS, and so that information is gated. So a similar situation would be where somebody in the compliance, a compliance investigator would reach out to a teller and say, "Hey, we saw a customer withdraw $10,000 three separate times in the last 3 weeks. Any idea why? What's going on?" And the teller, because they know their customers, because they see them daily and interact, they say, "Oh yeah, that customer is just, they're remodeling their house, getting ready to put it on the market. They're paying different contractors in cash." So although that activity is different than the normal activity for that customer, you can say, okay, that's not suspicious, and we can disregard that alert. And so similarly, that collaboration with fintechs, where you just get a better picture and understanding of what's going on with the transactions, with the activity that is going on in a fintech context.
Yeah, and I think that's such a powerful analogy, right? Thinking about it from like a bank teller, and here we just have the fintechs almost stepping into the shoes of the bank teller. So we're just kind of shifting around who's doing what, but the banks still have controls in place. But on this idea of collaboration, Matt, and I know there are new approaches and the technologies that are out there that really allow for more collaboration directly into the tool themselves. We hear often from some of our regulated financial institutions that level of collaboration could be problematic. What are your thoughts on, having kind of multiple players playing different roles and having technology facilitate a level of collaboration that maybe we haven't seen before?
Yeah, I think it it's extremely valuable. Our approach in thinking about this is collaboration is just creating more effective fraud and risk management. Again, I think we're banks. They do such an unbelievable. They have a great job of understanding the nuts and bolts of how how to handle investigation, and what are characteristics of suspicious activity. But again, um, they're just starting to distribute their services again, right? Their license, their accounts through third parties that are having these relationships with customers. So as you're looking at fintechs, they understand, right? They're marketing to them. They're doing assessments of their customers. They're understanding how and why they're buying their products. And for
Yeah.
banks, this is just areas that they're operating in. And so as we look at this, we think it just creates, even though it's new for banks to be able to collaborate with fintechs, we think it just creates such a more effective method of risk management, because now you have more context from your partner. So if you see these suspicious activity, you can say, "Hey, this does look suspicious. Can you add some context to here?" And you can maybe get feedback from a fintech saying, "Hey, this is how this product is designed to act. I know it's unusual," and that could be helpful, right, for your bank investigators. So they're not spending, let's say, unnecessary time investigating false positives. They can spend more time effectively in investigating true types of fraud and suspicious activity.
Absolutely. And I'd love to kind of unpack this a little bit further, because a lot of, what we help solve for on behalf of our bank partners and financial institutions that we work with is this idea of, why can't we just use core transaction monitoring systems, or why can't we use a similar approach that we do to transactions that happen on the bank's core to this line of business and this new line of business? And Matt, I know we've had conversations before about what we see happening when there's not effective, or when the market thinks there's not effective fraud and financial crime monitoring happen. And that's the example of certain MCC codes being blocked, and certain hotels not accepting debit cards. So what are your thoughts on this as we are talking about kind of this new way of looking at fraud and a new way of looking at financial crime as it relates to fintech portfolios?
Yeah, if you're looking at sponsor banks and fintechs partnering together, right? The incentives are aligned here, right? Or at least they should be. That if banks, they should want their fintech partners, they should want to see them grow. That benefits them, right? More transaction volume, maybe capturing more deposits, maybe extending more loans, whatever your partner is, whatever types of service your partner is engaging in. As a bank, you want them to be successful because that's going to have a positive impact on your business. And if the fraud and risk mitigation is, let's say, not as effective as it can be, there's a number of things that can happen. Certainly, from a fintech perspective, there's reputational risk. We can go into that a bit more. Customer experience is right. If there's ineffective measures around like fraud and risk, the customer experience could be poor, which could lead to customer churn, which again, not good for both parties. And then, when we take a look at, you touched on this, there's recent news, right, in around about certain, let's say, we can call it hotels, rental car, maybe even marketplaces, just completely blocking certain types of fintech organizations because they've had ineffective type of fraud and risk measures, put in place. And that doesn't solely, that's not solely on the fintech. That's not so, you can't put, you're not blaming either party, but there's probably more effective, let's say, monitoring that could take place. And when that's not done, and if you block, let's say, a certain fintech from actually engaging with business with a merchant, that's a terrible customer experience. You don't want to wind up on the front page of newspapers or tech magazines about this, because customers are inevitably going to churn, and that just ruins the entire value proposition of fintech in the first place.
It's so interesting, right? Because it almost becomes a self-defeating cyclical cycle that we see, where we have the whole rise of fintechs, and the entire boom that we're seeing in the fintech is based on this better customer experience. And yet, if we can't figure out how to make adjustments and how to do things maybe a little differently, it's potentially going to really quash that entire demand that precipitated the growth of fintechs in the first place. So it is, I think it's a very interesting problem. And I think that the pandemic, what we've seen in the pandemic, really highlights the fact that whatever our solution is, we all together have to figure out a way to solve for this. But I do want to switch gears a little bit. I think we've talked a lot about kind of how we want to approach this from the bank and the regulated entities lens. What about shifting gears to look at this from a fintech perspective? And Tanya, maybe we'll start with you, and then Matt, would love your thoughts also. Why would a fintech want, if I'm a early stage fintech and really just focused on growth and getting to market, why would I want to even contemplate having accountability or any level of ownership in something like transaction monitoring? And Tanya, maybe we'll start with you.
Yeah. So there's a couple ways to look at this, and there's the financial perspective, and then there's a risk perspective that Matt has kind of mentioned on. But from a financial perspective, like you want to, or as I've mentioned, roles are starting to shift. So I think if you are directly looking at your activity as a fintech and kind of getting that head start, you're just positioning yourself better for the future. So as rules are shifting, I think it's important to educate yourself in the compliance space, because you're going to understand that activity that's going on and what looks suspicious and what doesn't. And the filing behind it as well. From a risk perspective, like as well, if you're going to outsource this completely, you're going to miss the risk that your customers have for your company. So I think it's, from a risk perspective, it's really important that you're directly involved in the transaction monitoring piece. I think it's important for fintechs to educate themselves in the BSA AML space and compliance space, and partner with a bank because banks are the experts in the compliance space. So partner with a bank where you guys can work together when it comes to transaction monitoring, because as innovations progress in the financial industries, laws are going to change and regulatory responsibility for that matter will most likely evolve as well. And so you're just going to position yourself better for the future.
Yeah. And to your point about kind of this bifurcation of almost credit risk and then financial crime risk, we often see intersectionality there, right? Where we see fintechs that are actually very organically involved with helping banks or bringing ideas or potential use cases of fraud to the banks because there's intersectionality there. So there's that kind of added benefit. And not to mention the synergies with having fintechs being involved just helps alleviate staffing concerns that are really, all often front and center for banks. Matt, what are your thoughts on kind of this fintech? You work obviously directly with fintechs as well as with banks. How do you approach this question of fintech accountability and fintech involvement in the process?
Yeah, I think from a fintech, and you're saying why would you want to take part in this process? And my answer is like, why wouldn't you want to take part in this process? Fraud and risk, are a key component of offering financial services products. And if you're allowing your bank partner to operate in a silo, they don't. We've gone back to this. They may not fully understand the intricacies of your business. And so if you can demonstrate to them and show them that you want to be an active participant in fraud and transaction monitoring, um, the goal with that is first that you're going to have the ability to reduce like false declines, right? Because again, if a bank doesn't understand, let's say, the intricacies of your business, there is a risk that they're going to put tighter controls in place, right? Because they may be exposed from a regulatory perspective, so they may want to put tighter controls in place. From a fintech, if now this is coming from a fraud perspective, you may be might have some more liability around the fraud side, depending on your relationship with your banking partner. And so, again, I think that if you know your customers best, it can create certainly a financial incentive for you, understanding your customers better, to put the appropriate, let's say, models and risk parameters in place. And then, as Tanya alluded to, um, you know, I think that you can. I think that in some conversations, you can expect that. I think that regulators, they're supportive of innovation, especially if this can be beneficial for the customer. And that being said, I think that they can probably expect that over time you're going to ask for maybe some more control of fintechs to be able to take a part in this. And so it's better to get a start early on this than later,
Right.
in taking some
Right.
control of fraud and risk mitigation.
Yeah, and we're seeing those trends manifest today already, right? With certain fintechs either choosing to, follow the BSA or actually voluntarily complying, even though they're not necessarily directly regulated. So we kind of see all trends. And then, to Tanya's point, the scalability argument, you look at the top performing fintechs, globally, and they all are controlling their own compliance programs. So it just seems this space is so inherently regulated. There's no way to grow without at some point taking some level of ownership of it. So I think that resonates with what you both have said. And I know I want to leave maybe 20 or so minutes for questions. So maybe we'll round out this discussion on this idea of controls. I think one thing that we hear often from our bank friends is this idea of how do we ensure controls that exist in traditional approaches to transaction monitoring while adhering to or leveraging new tools. And so maybe Tanya, you can speak, and I think you kind of covered this earlier, but like we can dig into it a little bit about SAR filings and additional controls that we see. How do we maintain that in new tools that maybe allow for more collaboration?
Yeah, so like I've mentioned before, I think using tools that can really help collaborate between fintechs and the banks will really set up the bank for success, set up the fintech for success. So again, evaluate your internal tools to make sure that they they're effective, that they can capture the activity that's going on. And, again, like following the spirit of the law instead of the letter of the law.
Yeah, and I'm sure you saw this in your years with the bank, that it seems that we're either always overfiling or underfiling, and not as optimizing the actual and isolating the actual activity that we're looking to do, because we're just applying a lot of blanket rules to, voluminous transactions. So I'm sure that kind of really just, adheres
Exactly.
to your point of spirit of the law versus the letter of the law. No, I think that's a great point. And Matt, maybe where we can end this discussion is talking a little bit about uh, evolution in technology. I mean, we talked a little bit about configurability and ease of use, but um, why is that important? Why would that be important if I were a bank or a fintech to be able to have that ease of configurability and flexibility in things like transaction monitoring rules?
Yeah. So I think we can probably all agree that the pace of innovation is not going to be slowing down. Um, we're starting to see things, right? And where banks are actively participating. So we started out with just neobanking, but now we're moving into payments. We're moving into lending. We're moving into embedded finance. We're moving into crypto, and all of these are coming to a head, right? And I think you've moved into multiple generations of fintech, and that's extremely exciting. I've been involved in fintech for a while, so
Yeah.
I think I'm that old, but I feel old. And this,
Before fintech was even a thing, right?
before fintech was a thing, and so it's necessary if banks are going to remain um, a participant and are going to be successful in this, they're going to need to have flexibility to adjust to these changes. If you've looked, when you take a look at, banking over history, right, the number of products, let's say up until you get into the 90s that were offered, you had checking, savings, CDs, right, maybe money
Yeah.
market. Look what's happened in the past, like just few years about the number of products that are being offered, the types of customers now that banks may have the ability that may need to start monitoring. You might have not been monitoring, in before a 20-something-year-old that engages through mobile apps primarily in cryptocurrency and is moving funds and doing peer-to-peer payments. That's wild to think of. And
Yeah.
you need to have technology tools that are allowing you to effectively monitor that, even if it's not yourself as an organization offering that. And so you're thinking about flexibility. How can I adjust for this quickly on the fly? How can I test and make sure my rules are effective? Both backward testing, forward testing, and then in real time. How can I do things like, how can I effectively analyze across my entire network to see if there's anything that's suspicious? How can I incorporate things like machine learning into my
Yeah.
models? Can I get feedback, a real-time feedback loop, and see if my models are effective? Should I be changing my thresholds? And that's just, I think, having that type of conversation and thinking about how is my tech stack supporting this are important. And it's not just important, right? And I want to touch on this is I think, innovation departments at these banks, they're great and they're forward thinking, but I think it's just critical if you're in an innovation seat at a bank, make sure that you're bringing your compliance and risk department along for the ride early in the process. Involve them in all of these decisions, not at a later stage, because it's important, because risk and compliance, transaction monitoring are so
Yeah.
key to the success for the bank, but your fintech partners, and just generally as the industry as a whole. If you believe in fintech, I think that you want this entire industry to succeed, and having a proper controls in place is critical to putting a positive light on this.
Yeah, and I think that's a great note to end on. I think to your point, and I think both of you addressed this, I think banks and financial institutions and fintechs, really all players, we've become really good at propagating this culture of compliance, but now it's almost become a buzzword of sorts. And so now we have this space where we need to make sure the culture of compliance is intersecting with the culture of innovation and finding what that crossroad really is to be able to support this business line. Because I think what we see is fintechs and this new way of consuming financial services, it's not going away. It shouldn't go away. There's such synergies there between fintechs and traditional banks. And so we have to, all of us, as players in this space, have to take some ownership in helping really effectuate that transformation and educate regulators, push back on regulators, and really getting away to what Tanya mentioned is focusing on kind of the letter of the law and focusing the spirit of the law. Let's move away from the formalistic number of alerts and what's the tool. It really should be focused on what's the intent of all these tools in the first places. And I think it's not at all an easy problem to solve for. It's so nuanced and complex, but I think all of us really adhering to it and playing a role in it is going to help continue to move this compass. I think with that, we will open it up to questions. So first question, maybe Matt, you can take a stab at this. The question is, why doesn't a company like Unit 21 use the data provided to them by their various partner banks and fintechs to match up the data, accounts, identities, and activity to identify fraud? So I think that the question is aggregating data almost is what it sounds like.
So I'm just looking at that. Why use the data?
Yeah.
So there are ways that in certain cases, there are ways that can be possible where we are linking across partner banks and fintechs, but also there are certain privacy types of guidelines that we do have to keep in mind in terms of like if we are working with different types of partner banks or fintechs, making sure that what can we or can't we reveal between each of these entities. Ideally, I agree. Just being able to say you have Bank A and then you have Bank B that are working across different types of fintechs, being able to say here's the same customer and or here's the same user using a social and identifying that would be key. But I will say that there are some things that we are working on, which I can't reveal on this webinar. That will hopefully satisfy what that question is trying to say how can we anonymize that and send and share kind of like risk factors across different entities, banks and fintechs. But there were some things around privacy and PII that we just have to be cautious on in terms of what we're sharing. But I think it's a great use case and some things that we are.
Yeah, absolutely. And I'll just add to that, obviously, with the robust privacy and data security laws and cybersecurity becoming so top of mind for regulators, I think it is very tricky and it's very regional based on where the individual who the data belongs to resides. And so being able to share data, I think, is really kind of a bit of a maze of its own. But things like machine learning and using clustering models, kind of, even though you're not doing that across banks, you're still achieving that through the portfolio of at least for a partner bank for all of their fintechs, and having that different lens that a lot of these traditional tools, you get it only at the transaction level, right, Matt?
Yeah, and one thing I will add is just to say that one thing that we do leverage and is leveraged by our fintech and banking partners is we do see what types of models or rules maybe are highly used in different types of like thresholds. So not typically saying, okay, here's one customer and that we're and this is here's the user and saying this user is blocked. But we are using things like saying, here's thresholds, here are different types of rules and models that have been successful across different industries. So, right, one may be useful for like crypto, one may be more useful for neobanking, one may be more useful for a lending. And as we see those different categories, we actually share and highlight and surface that. So that's one way that we do provide kind of like leveraging, let's say, valuable types of like models across our network, and if you think about it like in a consortium type of way.
Absolutely. No, it's a great point. Here's another question. Maybe Tanya, you can take this one. Would there be a scenario where a fintech is ever filing a SAR?
Well, I mean, I think it depends. Generally, as we mentioned, like the bank and financial institution really has the responsibility for filing suspicious activity reports. And fintechs can inevitably provide details similar to the example I shared, where like a teller today gives more information to the compliance team. And yeah, fintechs, I don't think they would necessarily be filing SARs unless there's a caveat where they're directly regulated as a crypto company or they're a licensed money service business. But generally, I don't think they'd be filing SARs, at least not today.
Right. No, that makes sense. So here's another question, and maybe we will talk about, let's see, here we go. So there's a question about escalation and, having an internal tier system of escalation to ensure that the intent of the transaction was indeed suspicious. And I think, Matt, maybe we will start with you, but it seems like that's the collaboration that's built into tools like Unit 21 kind of allow for that, right? This idea of building instead of what we see traditionally today, and I'm sure Tanya can speak to this from her days at the bank, what we see today is a lot of these discussions happen over email, or they happen, in outside of an actual transaction monitoring tool. Some of these new approaches, like Unit 21, just allow both parties to collaborate into the tool themselves. Maybe you could speak to that.
Yeah. I think that one thing that we found is that we've worked with banks and fintechs on this challenge, and one of the things that was evident was there was a drop off when let's say transactions, and I'm sure most banks here and probably some fintechs, they can relate to this, is that something gets flagged at one entity or the other. You type an email, you send it out, and now it's sitting in the email box of your partner bank or your fintech, and it may get hopefully it gets picked up. Certainly, there's no audit trail around that, or it's tough to perform an audit trail. So we found that one of the critical things to be able to do was to say, listen, if something is created by let's say created by a bank or a fintech off of those rules, is to be able to say within a platform, how are you sharing that? So now you're sending this complete context of that alert and case over to your partner so that they can add comments. And so it's when you can put in your own rules and say, this is how we want to act, and here's our mode of operations. But we look to provide that within the tool, so that they can actually start collaborating in real time. And then, importantly, as you start thinking about, regulation, and I don't want to come across as saying this is exactly how regulators will look. But you do want to look and say, okay, at least they can track. Say, I see how this is handled. I see how you're collaborating with your partner. I see what your intent is here, and I can follow that exact path within the platform. And so as you look at, as you go back to talking about spirit of the law, you're saying like your goal, I see how you acted. Your goal was to gather additional information. I can see this. I can see how you attempted to escalate this between each other and come to a reasonable decision on how to act and how to act appropriately.
Yeah, it's interesting because I think the whole reason we even have case investigations and we don't just file SARs directly based on alerts is because context is so critical, right? Context is so critical in determining whether underlying activity is indeed suspicious, is indeed indicative of financial crime. So I think this new approach and some of these new tools just allow for more robust context directly in the system itself. And so we have a few more questions, but to the extent attendees have additional questions, feel free to put them in the chat. So Tanya, maybe you can talk to this. The question is about a consortium approach, and is there a version of check systems for fintech end users?
So I'm not sure if there's a version of it, but on a high level, for those who don't know what check systems is, it's a service that provides financial institutions and other companies knowledge of whether checking accounts or saving accounts have been closed or not for that person. So I think using, a system or a tool similarly to that is a great first step in knowing your customer. Um, it's a great way to assist in the account opening process, but I think there still needs to be a level of, where you manually go in and look at that information, because I mean, people are found in lots of different situations in life where they have to have their accounts closed, so I think it's a great layer on top of, looking at your customers and really knowing your customers, but I wouldn't say, rely on it completely.
Yeah.
I'll just add,
Matt, yeah, go ahead.
yeah. So as you're thinking about that, I think you're thinking about a consortium approach of fintechs. I think it's like great. The major banks, right, have historically had tool. Um, they've used a tool that they've been able to identify with a bank account, like check systems to understand and to put in some fraud and risk approaches. So I th- I think that a tool for fintechs would be useful. Um, I know that was a post from an earlier question as well. It does require work. I think it requires collaboration. It requires developing trust among fintechs. Uh, what it's who is sharing what, commitment from a number of fintechs being willing to share, consistency across data as well, and understanding what is being shared, and also how is it being utilized. Um, and so there are some network, right, putting in some like a network policies that are critical. I think if
Yeah.
we can solve some of those, I think it can be extremely powerful, especially as fintech is growing so much. And I think what you start to see is a younger generation. I don't know what we're on now. I think Gen Z maybe, but as just Gen Z are opening more accounts at fintechs. Is that going to be their primary financial services provider? And so, how can we effectively monitor that across let's say fintechs? Um, I would say within Unit 21, we see that's something that's really important, and we do take a look at that. Again, can't really comment on anything beyond that right now.
Yeah. Well, and it's interesting because this is still such a new space, right? So even, even though we may not be at a consortium approach today, what some of these new tools, I mean, what we're precisely trying to refine is this idea of trend analysis and having better data and having, sufficient confidence in some of these trends, which I think will be a precursor to things like looking at things in consortium. We have a question, and maybe I'll take a stab at this one. So the question is, what do you believe is the legal standard for sufficient transaction monitoring that applies to fintechs? Are there differences in real life versus statutory factors that regulators take into account when a fintech comes under scrutiny for their transaction monitoring policies and procedures? So I'll just start off by saying, obviously, this is not legal advice, but happy to kind of answer the question in a general framework. So I think that this is the entire puzzle that we're in, right? The entire discipline of transaction monitoring isn't statutory. It's very subjective, and it's all about measuring risk and having rules commensurate to a potential or particular organization's risk profile, size, and complexity of their operation. So this, even though the BSA AML requirement for transaction monitoring is itself statutory, the components are still highly subjective. And so this goes back to what Tanya was speaking to as far as roles and responsibilities. Fintechs today, if you're not directly regulated, there's really, at least as it stands today, no regulator that's going to come asking you directly for your transaction monitoring policies and alerts. But the way that we see this manifesting is through bank oversight, right? And there's such emphasis today on banks and sponsor banks to have appropriate third-party controls over their fintechs and the fintechs in their portfolios. And so the way we see this is, how is a bank partner, the bank partner almost in that paradigm acts as your internal regulator if you're a fintech. And so your policies and procedures are to get the bank comfortable, even if you're never going to have an OCC exam or a Fed exam. And so that's kind of the complexities in this paradigm is we don't have a lot of data on how regulators would view this directly, and the standards themselves are so subjective. But, I think in my experience, and then I would love Tanya and Matt to jump in as well. I think, at least in my experience, what we see is what regulators want to see is not that you're eliminating all fraud from your platform. That is just like an impossible task, right? What they want to see is that you have sufficient controls, you have policies and procedures, and you have appropriate tools to detect transaction monitoring. And so that you could, the whole point of transaction monitoring isn't necessarily to stop the transaction. It's to be able to report to law enforcement that, hey, you may want to look at this transaction. So I think the entire discipline is really predicated on these notions of a reasonableness standard. So I don't think there's kind of it's entirely in the gray. Tanya, I don't know if there's anything you want to add to that.
Yeah, I mean, exactly what you said. I think regulators really just want to see effective risk management. And, it might take a couple exams for your bank to go through with the new tool for regulators really to understand it and accept the tool itself. But like I said, they're really looking, and what you said, Sheetal, is they're really looking for effective risk management.
Yeah, and we understand the problem. I mean, all of us have either been at a bank or worked so closely with banks that we understand it's a lot of pressure that regulators have come in. They're used to seeing things a certain way. And so, it's probably, I can see you, if you're a bank, saying it's easy for you to say push back and, help educate the regulators. But really, I think that is what it's going to take, is for all of us to remind regulators it's not about a particular tool, and it's not about the number of alerts. It's about how effective is this? What's the risk profile, and what are you doing to kind of, countenance that? So I think that is going to be a theme. I think, to Tanya's point, once we see, to the extent that someday we will see more direct regulation on fintechs, it's going to probably be more clear. But unfortunately, right now we're stuck in this very gray world.
I think, just to add, I think that regulators themselves, right? If I'm in their shoes, I mean, it's just support of innovation around the financial services, right? Because does it help the consumer? And if this is helping the consumer, that's that's, I think, what regulators are looking for, and just oversight, right? They want products to be better. They want more people to be taking part in the financial system. And fintechs have been just an unbelievable driver of getting underbanked and non-banked people to be able to take part in the financial system. That's wonderful. But in order, what they're going to be looking for, something that you want to do, and you want to play a partner in this role. If I'm them, thinking about, okay, but how are you how are you leveraging technology? How are you, if fintechs are using new technologies as, let's say, risk and compliance, how are you also leveraging technologies to help take things forward, and be supportive, and just being proactive in your assessment of risk to, in the end, help protect the customer, and I think that's something to keep in mind.
Yeah, I love to end on that note, because I do think we see what's so beautiful about this whole space is fintechs are so mission driven, right? And I think that instead of being scared by that, we really need to lean into that a little bit more. And some of that is it's going to be pushing traditional approaches, and having to be educators and having to be pioneers. But I think what we see, and I speak to bank partners about this all the time, is it's been really refreshing for us, at least, to see how fintechs are so committed to wanting to be compliant and wanting to do the right thing. So while bank partners have this very legitimate fear of their own regulatory exposure, we see this collaboration being very synergistic on so many levels, but particularly from a regulatory perspective. Excellent. So I think we're on time. Thank you all so much for attending. I think for all attendees, we are going to make the recording of this available, and so you'll be hearing from us. Thank you so much, Tanya and Matt. It was a really great conversation and a very interesting, relevant topic. So it's been really a great time.
Thank you.
Awesome.
So
Thank you.
All right. Thanks, everybody. Bye-bye.